James Blacklaw's JB Commercial Finance here. Now, today is the day that many have been waiting for, when Bank of England have increased the base rate of interest over 0.5% for the first time since 2009. That means that the current base rate, announced today at 0.75%, which is a 0.25% increase on what it was previously, is the highest Bank of England base rate since before the financial crisis. So it's 9 years, a thick end of a decade now. We've got used to a maximum interest rate set by the Bank of England of 0.5%. It has been as low as 0.25%, you may recall. So what does this mean for me? What does this mean for you? What does this mean for the wider economy? Well, I've had this kind of discussion before in videos with regard to the influence of interest rates and how it can impact on you. In a nutshell, it means that the borrowing of the cost of the borrowing you currently have, if it's variable rate linked, is going to go up by 0.25% per year. So if you had a mortgage of £100,000, 1% of that is £1,000, 0.25% of that is £250, and that is on an annualised basis. So your mortgage of £100,000 will cost you £250 more in interest in the next 12 months, which roughly translates to being just over £20 per month. So if you've got a 200 grand mortgage, you're 50 quid a month worse off today per month. So great news. So what this means is that people will have less money to spend on consumables because they're putting more money into debt. So if you've got a £100,000 mortgage, it'll cost you £250 per year. If you've got a £500,000 mortgage, all of a sudden you're going to find quite a bit more money every month. Also has an impact if you have a credit card, because credit card fees are likely to go up, or the stuff I deal with more often, if you have a variable rate commercial loan or a commercial mortgage, it will cost your business more to repay that on a monthly basis, which is going to have an impact on the serviceability of it, which is going to have an impact on the bank's willingness to lend more. So the interest rate increase is a bit of a dampener, but that's what it's designed to do. It's designed to dampen spending. It's designed to dampen the property market because these things have increased and increased. Interest rates have traditionally been used as a way of controlling inflation. And that's the way the Bank of England, previously the Treasury, but now the Bank of England have used interest rates. If you increase interest rates, people are having to spend more money on their debt, therefore they're not spending money on consumables, the goods in the shops, which means that inflation levels off or actually comes down. The only time when there's a massive problem in the economy is if this doesn't work and interest rates are sky high and inflation is also going up, and that's called stagflation, which has not happened very often in this country. When it did happen in the 1970s though, it led to major problems. So it is a very traditional tool used by the monetary experts, but the impact on guys like you and I, we need to know about and we need to take account of. Because it does impact, it does mean that borrowing does get more expensive, and it does also bring up the question of fixing your interest rates. Now, this is something I've talked about a lot of times, and it's certainly not something I advise on. It's not something I'm allowed to advise on. It's not something anyone in my position does advise on. And if they do, if a bank manager or a broker advises on this or gives you some strong guidance, then that is very wrong. It is a customer decision, but they have to have the option. And it's likely that fixed rates are going to get more expensive as of today, because the Bank of England have broken the seal. They have increased interest rates above the 0.5%, which has been so steady for so long, and now we may see a bit of a rapid increase depending on the impact of that 0.25%. So if inflation continues to be along the same sort of levels at this moment in time, which is relatively good, then I can see base going up to 1% by the end of this year, and all of a sudden some of the markets may begin to panic a little bit. We may see fixed rates up at around about the sort of 6% mark, 6-7% mark, the 5-year fixes, which we saw back when interest rates were back at 4%. So that could happen. It may not, but at this moment in time, if you've got a fixed mortgage at around about the 2% mark, which a lot of people have, you should be very happy, because I believe that will look like an absolute steal in a couple of years' time. So this, it's only happened today. There's going to be a lot of a lot of talk about it, a lot of wind. But in a nutshell, if you're borrowing money on a variable rate, credit card mortgage, commercial mortgage, it's going to cost you a little bit more as of today. So sorry to be the bearer of bad news. If you want to talk about fixing your loan, look at your options, look at what you may be able to do to mitigate this, then please give me a shout. James Blackwell's JB Commercial Finance. Please like, share, subscribe, and I'll speak to you all very soon. Thank you.